All right, if you've seen the first lecture, if you've seen this first video, now is the time to look at this video to revise another really important chapter from CA Inter perspective. It's a very important chapter. It'll get you a couple of marks definitely, and one practical question from this chapter is definitely expected. Which chapter are we talking about? We're talking about an interesting chapter called Income from House Property. Yes, we've jumped from the first chapter of introduction to straight ahead because that's how we do it. Guys, we will do this entire revision in the same way that we do in our regular classes. So the next chapter and the next revision is of this amazing chapter at CA Inter level called Income from House Property. May 21, November 21, all amendments, every section is being discussed in this next revision, this revision lecture. All right, guys, let's quickly look at what we're looking in this chapter. I'm just going to increase the video size, just 1 second. Perfect. All right, so income from house property. And how did we do this chapter? This guy is the surgeon, really wanted to buy a house, and at the age of 22, that's section 22 because that's where IFHP starts off, he bought his villa. Remember all of that. Guys, how did he buy his villa? He took a loan on which he was paying interest and he bought the villa. I'm just taking you to this story so that you recollect everything. Guys, he could have taken the loan from his brother abroad or his father in India or from an Indian bank or from a foreign bank. He had all the options available, but he chose to take a loan from SBI, and when the interest rates were high, he switched on to another loan from Kotak Bank. All right. Besides that, guys, the first thing that he did in the house was stay in that house. But then, sorry, the first thing that he did in the house, my bad, was let the house out, LOP. Just 1 second. The first thing that he did with the house was LOP, he let it out. Next thing that he did with the house was SOP, and so on and so on. Guys, also reminding you that in case of IFHP chapter, he had taken a loan and he had constructed this house. Let's see every section from this chapter called IFHP. Guys, the first thing that you do in this, when you buy a house, and the first thing that you do in section 23(1) is called LOP, let out property. In case of let out property, he was renting it out for 1 lakh a month, but the government does not believe him. So they compare the actual rent with the expected rent. So your actual rent is compared with the expected rent. What is the expected rent? What is the government expecting? Municipality figures the standard. That is the municipal value. As per the municipality, what should be the value? What should be the rent? The fair rent of neighborhood houses, and both of them higher of municipal value of fair rent, but subject to the ceiling of standard rent. Let's take an example, guys. In our surgeon's example, the municipal value was 8 lakh, fair rent was 9 lakh, and standard rent was 10. So, guys, it is within the ceiling, 8 or 9, whichever is higher, subject to the ceiling of 10 lakhs. So, 9 is the highest. So, expected rent was 9. Actual rent, guys, in our case, he had given the house on rent of 1 lakh rupees a month. So, that was 12 lakh. So, AR or ER, whichever is higher, here EAR is higher. But of course, can you minus unrealized rent? You can minus unrealized rent. In case some tenant does not pay, you can minus unrealized rent. And guys, for the shortcut for unrealized rent is legally vacate our building. That means to minus unrealized rent, all these 4 conditions should be satisfied. Remember, legally vacate our building. That's shortcut you should remember. So you should have filed a legal case against him. You should have asked him to vacate the property. You should have no other property of yours with him, and the tenancy agreement should be bona fide. If that is the case, then you can minus unrealized rent. And after minusing unrealized rent, let's say in this case there was no unrealized rent, so after minusing that, your AR is 12, your ER is 9, and so whichever is higher, guys, your AR is higher, so you will choose that. Now if when AR is higher than ER, can you minus any vacancy loss? First, what is vacancy loss? So guys, in case a tenant leaves the house and you don't even self-occupy, there's no one in the house, that period is called vacancy period, and for rent which you don't get for that period is called the vacancy loss. So can you minus that? Yes, you can minus that, but only and only if AR before minusing vacancy loss. So you first ignore vacancy loss, calculate AR, ER. If AR is greater than ER, only then you can minus the vacancy loss. Guys, that's your concept of vacancy loss and unrealized rent. Guys, when you figure this, AR or ER, whichever is higher, in our case, AR is higher. So that becomes your gross annual value. That is, guys, 12 lakhs is my gross annual value. Now, after that, there are three deductions, guys. Everyone pay attention. First is municipal tax. Municipal tax you can minus, let's say municipal tax was 2 lakh rupees, you can minus only and only when you paid. So municipal tax is only on payment basis. If you paid last year's municipal tax also this year, then you will get the deduction this year also of last year's municipal tax that you paid this year. So how much ever you paid, doesn't matter for which year, how much ever you paid, you get reduction of that. And then whatever you get as a minus is called the NAV, that is a net annual value. Guys, after that there were two deductions. One is the ad hoc deduction 24A and one is an interest deduction under 24B. Let's go to the arrow deduction, guys. Arrow deduction is 30% of the NAV. So in this case, it is 3 lakh flat. No matter whether you spent on repairing that house or changing the taps or changing the color of the house, they don't know, they don't want to get into the details whether you spent it or not. You will get a flat deduction of 3 lakh rupees, that is 30% of your NAV. Plus, guys, any interest that you pay, whether to an Indian bank, whether to 2 3 banks, whether to your father, whether to anyone abroad, does not matter, guys. The government is smiling while they give you this deduction. Why is the government smiling when they give you this deduction? The government is smiling because whatever you get a deduction, someone else is going to pay tax on. So let's say you pay 30,000 a month, that is 3,60,000. So you minus 6,60,000. So guys, when you minus that, that is 4,40,000. Let me check that. 3,40,000. 3,40,000 is your income from house property, and this is how you'll calculate it in the case of LOP. Now, guys, in case you don't let it out, what is the next thing that you do? So 23(2) says you self-occupied. Now, in self-occupied, what all changes? Let's see what all changes, guys. Here, in this case, there is no expected rent because your house is self-occupied. There is no actual rent also. So in that case, actual rent and expected rent is zero, and hence your GAV is zero. Your GAV is zero, so your municipal tax is zero. You get no deduction. Guys, this is my favorite calculation. Your NAV also becomes zero in case of self-occupied house property. There is no add-on deduction because 30% of zero is also zero. But can I minus interest that I pay on this house now? Yes, you can minus. Guys, interest, there is no limit as long as you are making a payment, or even if you've not paid on accrual basis, you'll get a deduction. But guys, here in case of SOP, because there is a benefit. Why is it a benefit? I'll tell you in some time. But right now, guys, are you offering anything to tax? No, you're not offering anything to tax. So the government says, yes, we will allow you interest deduction, but interest deduction maximum, guys, in case of SOP, the interest deduction maximum is 1 lakh, or either 2 lakhs or 30,000. Guys, when is 2 lakhs or when is 30,000? So let me write just 2 lakhs here and give you the shortcut to give to understand whether 2 lakhs or 30,000. Certify 5 accounts for 99. Remember, he had to certify 5 accounts for 99. Only then you would give it this higher reduction. Another shortcut, guys. So you should have a certificate from the lender. You should have constructed the house within 5 years. If you are constructing the house, then you should have constructed it the year you start constructing or the year you take the loan. Ignore that year, and after that 5 years my construction should have happened. It should be for acquisition and construction only. That means not for repair, renewal, reconstruction. For that purpose, if you have, then you will not get this higher limit, and the loan should have been obtained after the 1st of April 1999. In that case, all 4 conditions are satisfied, then you'll get a higher limit of 2 lakh. Even if one condition is not satisfied, let's say you took the loan for repairing your house, then in that case the maximum deduction is 30,000. So this interest limit is only and only, guys, for SOP property, not for LOP property. Guys, how many SOP properties? Earlier you could have only one SOP property, but now in India you can have 2 SOP properties. So there can be 2 properties under your name whose gross annual value can be 0. Why is the benefit? Because this will lead to a loss, and that loss, in case there is any other profit, you can minus it against that other profit. So it will reduce your overall income and reduce your overall tax. This SOP property you can have 2. But guys, if I have an SOP property in Bangalore, but I have to move to Bombay for some work, then I cannot occupy the Bangalore property. Even then, it will still be considered an SOP as long as you don't derive any benefit from that property. So if you don't stay in that property, but your intention was SOP, then it will be continued to get the benefit as long as you're not putting it on rent. The moment you put on rent, it will become LOP. Guys, the next thing, 23(3) is LOP plus SOP. That means a part of the year you let it out, part of the year you self-occupied. In that case, 23 LOP plus SOP is equal to LOP. That means you go back, guys, you go back to all the same concepts under 23(1). That means here also you'll have AR and ER. ER, of course, will be the same. A municipality figures the standard. In case of AR, there'll be a split for the 9 or 10 months or whatever months you've given it on rent. You'll multiply it with the rent. And for the next 3 months which you've self-occupied, you'll multiply it by 0, but you'll always take AR as 12 months. You'll again compare AR and ER. Of course, you can minus unrealized rent from AR. Again, the same concept, legally vacate a building. And if AR is more than the ER, you can also minus vacancy loss. Guys, the same concept continues even in 23(3). What is 23(4)? 23(4) is when you have more than 2 self-occupied properties, guys. If you have 2 self-occupied properties, no problem. But if you have more than that, then it's illegal, guys, in India. Honestly, people don't have 1 house to stay. You have 3 houses to stay. So how can you do that? So the government says we expect some tax from that. So in case of that, they will call this more than the next, after the second house, the next house they will call it a deemed let out property. Good part is you can choose which house will be a deemed let out property. In deemed let out property, what do? There is no actual rent, so you only take the expected rent, and that becomes your GAV. No minusing unrealized rent, no minusing vacancy loss, nothing, because AR is not calculated only. And then from GAV, of course, you minus municipal taxes. You can minus your 24A and 24B. Everything is okay because you're offering something to tax to the government here in deemed let out property. Next, guys, in 23.5. 23 is the main section and we already are the fifth one. Guys, in 23.5, it's basically a person who's basically in the construction business. So example, a builder, not the bodybuilder but the construction builder, he has some flats, he has 5 flats which are unsold. So the year you get the construction, let's say your construction was completed in 2021 financial year, that is your year, the government says we will wait for 1 year and another year, we will wait for 2 years, we will wait for maximum 2 years, that is 21 22 and 22 23. We will wait for 2 years for you to sell your houses. But if you can't sell your houses even after 22 23, then we know what you're trying to do. You're not trying to sell these houses, you're putting them on rent and taking cash, and for that reason we will then start deeming it to be let out property after 2 years after this previous year. So ignore the previous year, after that 2 years, and after that they start calculating deemed let out property. Guys, that is section 23. Next, guys, section 24, you already done ad hoc deduction. You don't have to show any expenses. Flat deduction, as long as there is an NAV, 30% flat deduction, and that's why we call it ad hoc deduction. 24B, B is for borrowing, guys. When you bought a house which is let out, SOP, etc., and you paid interest or you're going to pay interest against it, guys, on that interest amount, you get a reduction in 24B. There is no limit to interest deduction unless it's an SOP. Guys, in case of interest deduction, there is also PCP interest, that is pre-construction period. What is that? So let's say, guys, you constructed your house in 2021. This is the year of construction. Ignore that. Before that, that means before 31st of March 2020, if you paid any interest for this house, then total of that interest and it will be available over 5 equal installments starting from this year and 4 more years. It will just be added to the interest in 24B. This interest is also allowed in case of SOP, but in SOP the maximum interest that is allowed to a person is maximum 2 lakh only. Next, is section 25. 25 says that in case you pay interest abroad, let's say you took loan from a brother or a bank abroad and you're paying interest, you should deduct TDS. They've told you to do one thing. If you don't do that one thing, then if you don't deduct TDS, then will disallow this interest expenditure under 24B. Next, guys, arrears. Some guy did not pay you, but after a couple of years he's paying you that rent. So that's arrears of rent received. That is taxable in the year of receipt, but of course you'll get a 30% flat deduction. Next, guys, is section 26. 26, at the age of 26, the husband and wife, the surgeon and his wife, started co-owning their house property. And in case of co-ownership, this is called co-ownership. Guys, in case of co-ownership, if the co-owned house is let out, that means if rented out, then no problem. Calculate normally GAV, NAV, final IFHP, and whatever final income is, it will be split between the two people depending upon their share or ownership in their house. But guys, if it's SOP, that means if two people, husband and wife, of any two people or more people co-own a house and that's self-occupied, then you have to make two separate calculations. Why two separate calculations? Because, guys, that 2 lakh or 30,000 benefit is not per house, but it's per person. So good for you. The husband and the wife or the two brothers or whoever's co-owning it, each will get 2 lakh or 30,000 as the case may be. Guys, that is 26. Next, 27, guys, you're trying to act very smart. The surgeon wanted to transfer his rental income from the house to someone else. So he transferred the house to his spouse, or he transferred the house to his minor children. In that case, section 27 says deemed ownership. The house will be transferred, no problem, but the income will come back like a boomerang and will be taxable again, considering the surgeon as a deemed owner. As the exception are, in case you're separating from your spouse and you give the house property, then no section 27. And also if the spouse has paid you adequate consideration, then no section 27. Same with minor, guys. If the minor is paying you adequate consideration, then no deemed ownership. Also, if the minor is a married daughter and you've given her the house, this encourages dowry, honestly, but this is also allowed and there will be no deemed ownership. In case, guys, you're a tenant, you stay at a place for more than 12 years, you become a tenant in that property, then that IFHP calculation will be in your hands because you're the deemed owner. In case of part performance of a contract, example, you've paid the money, you've taken the possession, let's say you've not signed the agreement, then in that case you cannot say that I'm not the owner, IFHP will not be calculated in my hand. You are the owner because part performance of the contract is done. Guys, in case of impartible estate, what is an impartible estate? Impartible estate is a big estate which has small parts which cannot be separated legally. They are all one part. So if you own one part, then you own the entire estate. And guys, last, in a cooperative society, even if you own shares, you're assumed that you're a member of the cooperative society. You cannot say that no, I will not be taxed under IFHP because the property is owned by the cooperative society. No, the property is owned by you. And that's the last section on IFHP, guys, is section 22. The section 22 is general section, which says that house property, although the name is house property, guys, it also applies to offices, it also applies to godowns, shops, movie theaters, any classroom, etc. As long as, guys, it is land and building which is rented out, you can tax it under IFHP. But guys, if it's your business, I'm just putting points, guys. If it's your PGBP business of renting out, then it will not be taxable under IFHP. You'll tax it under PGBP. Guys, in case of composite rent, that means you have given the house plus electricity, security, lift, etc. also, and you collect one charge. Then that charge, where will it go? If you can separate it, then separate it, and one will go in IFHP, the other will go in IFOS. But if you can't separate, you'll have to separate basis the cost of those services. But in case of composite rent, which is the rent plus facilities like furniture, etc., then in that case again separated. But if it can't be separated, then it will go to IFOS. You cannot manually or forcefully separate it. Also, guys, you need to own that property. That means if I don't own that property, what if the surgeon gave it to one person and the other person sublet it? And subletting is an income taxable under IFOS, not IFHP. Guys, this is section 22, talks about a couple of things. Guys, you should be the owner, but owner of the flat or the building, not the land. Even if you don't own the land, but you own that apartment, you can still give it on rent, and that income will be taxable under IFHP. Guys, one small concept, guys, when you're doing this and they say a portion of the house, let's say ground floor you rented out, first floor you're staying on your own. Guys, in case of portion of the house, not part of the year, part of the year, if it's portion of the house, then the word is apportion. That means everything is apportioned, right from municipal value, fair rent, standard rent, to actual rent, to municipal taxes, to interest. Everything is apportioned in the ratio in which they are giving, and that's how you will do it. Guys, as IFHP is an important chapter for CA Inter, one question is definite besides other MCQs. So do this well. I hope you've understood. And that's the end of the second chapter, which is called IFHP.